Investors became more risk averse in May, and this was most evident in commodity markets, where we saw a $10 drop in oil in one day, and over the entire month oil was down 10%, while silver was another big casualty, which was down 21% during the month. Equity markets were also more volatile, although the losses were much smaller in equity markets than they were in commodity markets. Core government bonds in Europe benefited from the flight to quality, most notably the German government bond, where the yield on the German government bond fell below 3% as the price increased. On the other hand, peripheral government bonds in Europe, such as Ireland, Portugal and Greece, suffered and made losses during the month. Weaker economic data in both developed and emerging economies led to the flight to quality. Particularly in the US and Eurozone, data came in much worse than people had been expecting. The labour market showed signs of slowing in the US, and business confidence in both the US and in Europe came off of their highs. In emerging economies, there was also signs that the tighter monetary policy that we had seen since the fourth quarter of 2010 was having an impact on economic growth in these regions. The impact of the natural disaster in Japan was worse than people had expected, as growth for the first quarter came in much weaker than had been expected. Expectations for interest rates have changed during the month on the back of this weaker economic data. For example, now the Federal Reserve is expected to keep rates unchanged until well into 2012. On the other hand, the ECB is now expected to increase rates at a much slower pace than had been thought in April, when the ECB started to increase rates. This has been reflected in bond markets, as we have seen bond yields in both Germany and France move lower. Also, equity market volatility has increased, and equity markets have suffered losses through the month of May. We expect that this increased volatility in equity markets and bond markets will continue for the summer months, as this waning of economic activity is digested by market investors.